Hey everybody, welcome back to Stock Investor. Just me today. Nick is busy fine-tuning his resume. According to some of our viewers, DeepSeek has rendered Stock Investor basically useless. So it's just me rebranding this as Healthcare Investor today. We're going to be talking about Intuitive Surgical. Intuitive Surgical has been holding in our portfolio for a long time, and we have been very happy shareholders for the duration. But we do get a lot of questions on entry points to make Intuitive Surgical or ISRG as part of your portfolio. And the most common argument we get about this is that Intuitive is too expensive. And it's true. The stock has and continues to trade at a very premium valuation. But let's break down why through the lens of this latest earnings report. Intuitive has multiple robotic-assisted, minimally invasive surgery systems. In 2024, there was a launch of another multi-port system, the Vinci 5, which has some pretty amazing new features, including force feedback. That's so a surgeon can tell how much pressure is being placed on the patient's tissue during surgery. This may sound like not a big deal, but if you've ever had surgery, you know that the pain at the incision site and wound healing are sort of a big deal. It's important. Softer and lighter touch via that haptic feedback helps better patient outcomes. And of course, that's a very cool semiconductor-based technology. That's one of the reasons we talk about this company here at Stock Investor. The Ion is a newer product that is used for lung biopsies, and that has been gaining a lot of traction amongst clinicians. We'll go over the placement numbers of some of these in just a moment. But first, let's talk about the Q4 and fiscal year 2024 highlights. In Q4, the revenue was $2.4 billion, up 25% year over year. Earnings per share, close to $2 on a GAAP basis. Nice, healthy growth for Intuitive Surgical in this most recent quarter. Before I show you the numbers for installed base and procedures performed, I want to tell you about the sponsor of today's video, which is finchat.io. We use FinChat for all of our charts here at CSI. You'll see them frequently in this video right here. And this chart specifically on Da Vinci systems installed base and the procedures performed. FinChat has the great ability to show you KPIs or key performance indicators just like this one. You can get 15% off of any paid plan. Link in the description below. finchat.io/CSI gets you 15% off any paid plan. So check it out. Okay, let's break down the procedure growth from 2023 to 2024. Intuitive had an 18% year-over-year procedure growth in that time period, nearly 2.7 million procedures in the last year. Yes, that's right. Nearly 2.7 million procedures performed last year. That's an increase over 2023, where they performed just about 2.3 million procedures. Just to give you an idea of just how big of a market share Intuitive has currently, there's at least 300 million, probably closer to 350 million procedures estimated performed each year. So Intuitive has some big numbers here, but really just a small fraction of the overall pie. Here's another visual created by FinChat. You can see the Da Vinci procedures performed. That's Intuitive's surgical system that performs all kinds of surgery, like various types of general procedures, gynecological procedures, urological procedures. But then that very small light bar, that's the Ion procedures. This is the one that is just starting to gain some traction, has a lot of room for growth in that field of lung biopsies, and hopefully eventually some more indications for that one as well. Let's take a look at the 2025 outlook that was provided by management from Intuitive. They expect that the procedure growth is going to be slowing a little bit next year. The range they have reported is a 13 to 16% year-over-year growth, down from that 17% year-over-year that we had in 2024. The reason for this, you might want to take a look at this quote from Jamie Samath, that's the CFO from Intuitive. He made this during the J.P. Morgan Healthcare Conference. He said 13% at the low end. They assume that bariatrics in the U.S. continues to decline about the same rate that they saw in 2024. Bariatric procedures, because of various factors, but primarily because of those GLP-1 drugs, declined into the mid-single-digit range in 2024. They also said that maybe China continues to be relatively weak given the environment there. And then finally, he said that in Europe, and CapEx and capital budgets, they assume that continues into 2025. And then for the high end of that range, 16%, maybe the decline in bariatric procedures moderate. China starts to recover and procedure growth improves in China. And then in Europe, the CapEx environment normalizes. Management also reports that there's going to be some decrease in profit margins. They estimate that their gross profit margin in 2024 will be 67 to 68% of revenue. The lower estimate is due to increased depreciation expense, growth in new products. Mr. Samath said this in the earnings call. He said the Ion and SP product margins continue to be dilutive because they're new products. It takes a little bit of time to ramp up the margins on them. They don't have as high of a profit margin when they're in the early days. And he also mentioned a stronger US dollar versus foreign currencies will also have an effect on gross profit margins. Here's another point that will affect gross margins in 2025. Management said that leasing rates are expected to be higher than in Q4. That means that hospital systems companies are getting those systems leased so that the cost of the system is broken up over time versus an outright product purchase where they get all of the money up front. Intuitive also plans on opening some new facilities for the da Vinci 5 and Ion system manufacturing in California. They have some new endoscope manufacturing facilities in Germany and Bulgaria. And so, as they have said in past earnings calls, they expect a significant increase in depreciation expense in 2025. There was also a sizable acquisition announced recently, one of Intuitive Surgical's distributors in Europe. Intuitive has been making a push to expand their outside of U.S. services, especially in Europe. And this will allow a direct presence in Italy, Spain, and Portugal. This acquisition is going to cost about 290 million euros and is not expected to be completed until the first half of 2026. Outside of the U.S. is a growing market, and it's still considerably smaller than inside the U.S. So this acquisition will help shore up the relationships with healthcare providers. This will perhaps allow Intuitive to offer some more flexible system payment options, and in the long run, increase profit margins by cutting out the middleman. In recent videos about Intuitive, we pointed out the free cash flow decrease that we saw the last few years. That was due to all that CapEx being spent on new manufacturing facilities, as well as a hefty R&D spend cycle, primarily for that new da Vinci 5 system. But now that that's out of the way, we can expect that free cash flow will rise as that CapEx moderates. You can see that illustrated in this chart, how free cash flow over the last few years has decreased significantly. At the end of 2023, you can see $750 million in free cash flow. They haven't posted the full year 2024 free cash flow numbers, but what is expected, you can see in the very right bar, huge addition of free cash flow. GAAP net income smooths out the profitability as the previous year's worth of CapEx that reduced free cash flow are depreciated. Notice that in this chart from our friends at FinChat. The more steady growth in GAAP net income, as well as a steady return back towards the nearly 30% net income margin from back in 2021. Pair that with stock buybacks, over time, we expect GAAP earnings per share to average a mid to high teens percentage increase, outpacing revenue growth by a few percentage points. We're going to come back to this in just a moment when we revamp our reverse DCF assumptions. So why does Intuitive Surgical continue to outperform and prove all those that find it too expensive wrong? Let's go over just a couple of points. First, take a look at the revenue mix. Revenue is heavy on the instruments and accessories in the dark blue bar. That's recurring revenue, actual real-life recurring revenue that has to happen for every single procedure done by a da Vinci system or an Ion system. That's the orange block in the chart. Those are poised to also make a comeback with the rollout of the new and improved da Vinci 5 platform. Perhaps a customer upgrade cycle will begin, and Intuitive also offers that lease program, which is great as it leads to more procedures over time. But really, it's that recurring revenue from disposable components that's a big factor in Intuitive's expensive valuation. The second point that we absolutely have to consider is that Intuitive is the undisputed leader in this healthcare robotics market, and they continue to add more features, updating software, and of course, integrating ever important and magic wand waving artificial intelligence, AI, into their hardware and software. There is competition, and they're up against several Chinese robotics companies, and that is definitely one of the headwinds that they have in the China market, and they're giving them a run for their money outside of the US. But Intuitive is the leader. So that leads us to our final point. Is Intuitive still a buy at these prices? The stock has run up significantly in the last year and a half, and we're more inclined to say that the stock price has future profit growth already baked in at this time. If you watch our previous videos on this one, you may note that we were of the opinion that it wasn't as expensive as it looked. But now it's starting to look a little overheated. Here is a reverse DCF that we ran to see one scenario that gives the business a fair value at the stock price today. Using Intuitive's last 12 months earnings per share on a GAAP basis, $6.42, and then using an expected earnings growth rate of 30% annually over the next 5 years, and then a 7% terminal growth rate thereafter, discount rate of 10% gets us to that stock price of around $580, where the last time I checked, it was around $575. This gets us to $580. This is a super high bar to clear at this point. 30% annual growth rate for the next 5 years. That's definitely not the average that's expected. It could happen, but it's a lot to ask for from this company that is beyond its stage of rapid revenue expansion, and with profit margins already approaching 30%. So what do you do for your portfolio? Well, if we were presented with two companies, one a startup robotics company with little revenue and no profit, but potential huge upside, but is untested at this point, or Intuitive Surgical, we would choose Intuitive every time. Over the long term, Intuitive has proven its potential to keep growing. Startup robotic stocks should be thought of, if at all, using a basket approach like a VC fund or venture capital fund, and assumed most, if not all, will underperform the market overall. A great deal of work still needs to be done for the robotics revolution to become a reality, so we would definitely be cautious on that front. Let's say you do choose to add Intuitive Surgical to your portfolio. Take it slow and add a position over time. Dollar cost average into the company, or DCA. And you have to be patient and wait for some pullbacks. More than likely, Intuitive is going to be having some pretty significant dips considering the current high valuation. But historically, ISRG has proved everyone who has said it's expensive wrong every time. So keep this one on your radar. Thanks for watching this episode of Chipstock Investor. Make sure you sub to the channel, like the video, and share with your friends. We'll be back with much more coverage of earnings and everything chip stocks. See you all again soon.